Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us here at Ausbits. So let's get across what happened on global markets overnight. They've responded to the outbreak of war in the Middle East as the conflict enters its fourth day. Oil and gas prices surging along with precious metals while equity markets fell, with European stocks suffering their biggest one-day decline in 3 months. However, on Wall Street, stocks rebounded after losses in the morning. The main indices boosted by the defence and energy sectors, while travel and interest rate sensitive stocks came under pressure. Stocks, specifically Nvidia, gained along with Microsoft, helping the S&P and NASDAQ cut losses. Defence stocks also got a boost, led by Lockheed Martin and Palantir, and US energy majors Chevron and Exxon rose, with US production remaining largely unaffected by any disruption to oil and LNG flows through the Strait of Hormuz. The airlines tumbled as the conflict wreaks havoc with flight schedules, while crude price sensitive cruise stocks also fell heavily. And Berkshire Hathaway fell as it reported a 30% decline in fourth quarter operating profit, hurt by lower insurance income and a write-down on its Occidental Petroleum investment. AES Corporation plummeted after a consortium led by BlackRock, owned an equity firm EQT, agreed to acquire the utilities company for $33.4 billion at a discount to its last closing price. And crypto stocks rose as Bitcoin rebounded. Well, RBA Governor Michelle Bullock says markets have been fairly orderly in the wake of the Middle East conflict, but has indicated any further spike to inflation means a March rate hike is possible. Speaking in Sydney this morning, the Governor indicated implications for Australia are mixed, given we are a net energy exporter.
The other possibility is that if this is a very prolonged conflict and there is a very elevated and lengthy rise in energy prices, this ultimately is going to feed through into economic activity. And I think uncertainty, if people are paying more for their petrol, they've got less money to spend on other things, this might impact consumption. If businesses are uncertain, that might impact investment. So all these things might impact the economy.
And the Governor has defended the RBA's decision to raise rates in February, saying every meeting is live and the board will be looking at it as it needs to move more quickly to quell inflationary pressures. Well, the conflict in the Middle East has widened, with Israel attacking Lebanon in response to strikes by Hezbollah, while Iran has continued to launch airstrikes on Gulf states. The US military is saying it has hit more than 1,200 targets in Iran since operations began on Saturday, and has destroyed 11 Iranian ships. President Trump has said the war could continue for some weeks.
We will easily prevail. We're already substantially ahead of our time projections, but whatever the time is, it's okay. Whatever it takes, we will always, and we have right from the beginning, we projected 4 to 5 weeks, but we have capability to go far longer than that. We'll do it.
Well, the conflict has caused chaos for global air transport and has shut down shipping through the Strait of Hormuz, where a fifth of the world's oil transits. US Treasury yields have climbed as surging oil and gas prices raise fears about escalating inflation. The US 2-year yield rising to close to 3.5%, the 10-year at 4.06. Australian 3-year government bond yields were up to 4.29%, the 10-year at 4.75%. US dollar index up almost 1% on the day, the Aussie trading at 71 US cents. Well, Iran says the Strait of Hormuz is closed and warns it will attack ships trying to pass. Meanwhile, Qatar, one of the world's biggest exporters of liquefied natural gas, has halted production with no prospect of being able to ship safely through the strait. And Saudi Arabia has shut its biggest refinery after drone strikes caused a fire there. Well, Brent crude is up around 6.5%, just at around $79 a barrel. Gold rising further on safe haven flows. Spot gold more than 1% at around $5,345 an ounce. Copper was down almost 2%, iron ore up 1% to 102 US a tonne, and Bitcoin has rebounded to be trading above 69,000 US dollars. Well, 2026 has so far seen a big rotation towards real-world physical assets. To discuss the opportunities, we're joined by Sam Ruiz from T Rowe Price. Sam, welcome.
Good to see you again, Andrew.
So, front and centre, of course, is the conflict in the Middle East. Has that only perhaps made those real assets even more attractive in this current environment?
Yeah, I'd say, it's a shock. It's devastating what's happening at the moment. The the footage you just showed actually was, it's incredible to see. It almost feels unbelievable. But what it really does, to your point, is it creates a third dimension to what we've been seeing in equity markets so far this year. So we've really, up until the weekend, been seeing two forces collide. We've seen the acceleration of the manufacturing segment and the capex cycle in the US economy. So for the longest stretch of any other period since the surveys began in the 40s, the US PMIs have been below 50 for about 2-3 years now. In January, we saw it surge above 50, and overnight, we actually had the second sequential monthly print of more than 50, around 52 on those PMIs. So we're seeing companies in industries or sectors such as industrials really accelerate on the back of that. That is really good for these real physical asset companies that do real things in the economy. And that force has been butting up against the concern we've been seeing in AI. So worry about disruption, we've seen it in software, worry about some of these companies spending too much. Now we have this third dimension, which actually creates more of a rush to real assets that are secure for investors in a world where we have to put a high risk premium in an era of conflict. And this conflict certainly feels like an escalation which is larger than any we've seen probably since 2022 when Russia invaded Ukraine. And not surprised by some of the moves we're seeing overnight in response to that.
Well, and we have seen that rotation, particularly out of tech, into energy, materials, industrials.
Yeah.
Is this a binary trade?
I think it's hard to say, is it a binary trade? I think it's very nuanced. So if you think about how investors traditionally want to invest, they want to put a value on forward-looking cash flows, what a company can actually deliver in the future. Now, if you're a company like Salesforce, for example, in software, investors might see you having a really good business now, but there's less certainty around whether AI disrupts your business in years 2, 3, 4, 5. So we're seeing the longer dated valuation of those companies compress. On the other side, we're actually seeing within tech, hardware companies be quite resilient, because amongst all of this disruption in tech is actually validating that this new AI tech is actually a worthwhile investment. It is proving that it can improve productivity. Companies are embracing it. That means we're very likely to see continued spending on building the capacity, the compute capacity of AI, which is really great if you're a company that's supplying, whether it's electrical conduit, optical connectors, whether it's the racks that all the servers go in that supply into Nvidia, that's TSMC are using, that the big hyperscalers are buying. So I don't think it's as much as binary, it's quite nuanced, but certainly investors are thinking, I have less certainty about the future, whether it's war, whether it's AI disruption. I'm willing to pay more in the near term for companies where I think there will be energy demand in 3 years' time, irrespective of some of these dynamics.
All right, so in particular, as you mentioned there, that AI tech hardware, you're seeing opportunity there, particularly as those hyperscalers build out that AI capacity. So where are you looking specifically?
So this is something where our view has changed. So initially it was all about those that are going to be the front-end monopoly suppliers to build AI, companies like Nvidia, for example, companies that have the ability to actually invest and potentially monetize AI. That's Google, that's Amazon, that's Microsoft. Now we're seeing a bit of a shift. The worry we have is that some of the forced competitive dynamics within AI world means that companies such as Amazon, such as Google, such as Microsoft will have to spend irrespective of whether they can monetize AI. And that's because all of a sudden AI is becoming a threat to their businesses that used to be monopolies. So if you're forced to spend irrespective of profitability, that's potentially bad for your returns, but it's really good for the ecosystem that you're actually buying all these components from. So we actually have quite a long list of companies spaced across the world. Actually, a lot of them are based in Asia. So companies such as SK Hynix, for example, or Samsung that provide memory. One hot tip for you, the memory prices have shot through the roof because the demand for memory in AI is extraordinary. It's very memory intensive, and there's only a fixed amount of memory supply we can even produce. So if you're buying an iPhone or a smartphone in the future, the cost to upgrade for a high memory handset is going to be a lot larger than you would have found in the past. So there's a wide range of companies supplying it. We just think this is a very cyclical sector that used to have sort of short cycles. But if these companies, which we believe they will keep spending to build AI, the hyperscalers, we're actually going to see a much more fruitful but longer cycle that we haven't seen before for these companies.
Sam, we were talking just before we came on about that response we saw on Wall Street, given the conflict of that first day of trade there. Perhaps surprised that they actually ended in the green.
Yeah.
Why do you think that is, and what are you looking for, that perhaps reflecting what we're seeing in the US economy at the moment? Clearly, President Trump wanting to pump the economy towards the midterms.
Yeah.
But now, of course, we potentially have that break of higher energy prices and the potential inflationary effect of that.
Yeah, so I think that is the question you need to ask right now and everyone has to think about. I'm actually quite encouraged by the market's reaction over the last couple of days for a number of reasons. Firstly, we saw the yields actually move higher yesterday in the US, but the day before that, when we was actually closer to the conflict, we actually saw strong demand for US Treasuries. That's very healthy because for the last 12 months, in times of stress, investors have been saying, normally I'd buy US denominated debt. I don't trust maybe the US government anymore, or maybe the US fiscal position is in a bad position. I don't want to own that, I want to own gold. So demand for US as a safe haven asset was actually quite encouraging. When we think about oil, the oil price, you said sort of Brent crude went up to about $82 overnight, and it wasn't really open until yesterday because it doesn't really trade very with much liquidity over the weekend. That actually saw oil traders selling it at around $80 a barrel, sort of to bringing it back down. So it shows that investors aren't wanting this to get away from itself and realizing that if you look at the last history back to the 80s in response to military conflicts, we've traditionally, on average, or the median, has actually seen oil prices retrace all their gains within 4 to 5 months. And we've actually seen any equity market weakness retrace losses within 4 to 5 months also. So I think investors are betting that this is probably going to be a short conflict. And I love the question you asked about the midterms. I would assume that Trump wants a healthy, growing economy without a conflict, which, let's pause for a moment, it is a very unpopular attack in the US. So it's only around 25% of Americans support this attack.
Well, particularly among his base.
Among his base as well, correct. So I think that it's likely, and Trump said 4 to 5 weeks, nobody knows how long this goes for, but I think investors are saying this is probably going to be a short, swift attack, and then underlying all of that, if this moves past us, the underlying momentum in the US economy particularly is actually really healthy. So we'll see how this plays out, but I'm just encouraged that the US equity market was 1.5% lower, moved higher, an encouraging reaction so far.
Sam, great to get your worldview. Thanks for joining us on T Rowe Price.
Thanks, Andrew.
All right, let's now focus on the local market ahead of the open on this Tuesday. So we are expecting to open lower. Mind you, we saw a fairly impressive recovery yesterday. It did finish in the red. Nonetheless, that was after a precipitous fall at the open there as investors try to get their heads around what is happening in the Middle East. Now, of course, we'll get across all the market moves there in just a moment, including some stragglers out of reporting season. Stay with us.